HIMS and Hers Health is a company that is up by almost 50% over the past month. Now today they are down by 4.25%. And so today in this video I want to figure out whether this huge rise in price is rational and the company will keep rising and buying the stock right now might yield great return, or whether it is irrational and the company will fall within the next few months. And to figure this out, we'll of course use our stock valuation spreadsheets where we'll have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of the company using our 4 valuation models. Now, after plugging in the ticker, we can see that the company isn't a dividend company. They don't currently pay out any dividends, and that makes sense as they entered the market in 2019. So I'm quite happy they're not paying out any dividends as they need to invest a lot of their free cash flow into growth. Now, something I do like about the company is if we direct our attention down here, we can see that their market cap is sitting at 6.74 billion, while their enterprise value is sitting at 6.50 billion, which means that their cash exceeds their debt. So even if they were to pay off all their debt, they would still have cash they will be sitting on. Now jumping to the 9-pillar analysis, we can see that it is not looking that great. The company gets a rating of 4 out of 8. And the two things that capture my attention is the 5-year PE ratio and the price to free cash flow over the past 5 years, both sitting at negative values. And this essentially means that the company has negative net income and negative free cash flow. Now, if we have a closer look, we can see that currently the P ratio is actually not sitting in the negative anymore. It's sitting at 71.74, which would still mean that investors are overpaying an extreme amount for the company's earnings. Now jumping to the price to free cash flow, we can see that that as well isn't sitting in the negative anymore, but it's sitting at 114. Now, even though I believe that HIMS will push their price to earnings and price to free cash flow ratios down over the next few years, for my taste, they are currently very overvalued. Now, we can also have a look at the company's growth. We can see that their revenue has been growing at a rate of 73%, free cash flow at a rate of 83%, and net income decreasing at a rate of 42%. But let's have a closer look and see what's actually happening. So we can see that the revenue has indeed been growing at a very high rate over the past 5 years, growing from 83 million to 872 million in 2023. Now, regarding the net income, that has been sitting in the negative since 2019, but has been getting closer to zero. So we cannot really say that it has been decreasing. Now, let's also have a look at the free cash flow. That as well has been negative in 2019, but has turned to positive in 2023. And in 2024, it rose by another 186%. So even though over the past 5 years, the company has mostly been in the negative, they do have very nice growth in all 3 areas. Now, before we continue, I just want to say these spreadsheets are very useful to both beginner and advanced investors. Whenever you see a company on the internet that interests you, you can simply jump to these spreadsheets, plug in the company's ticker, figure out its intrinsic value, and go through the 9-pillar analysis and understand whether it is worth researching this company further to possibly add it to your portfolio, or whether the company is simply not worth your time. And currently we are running a Christmas discount. You can find the discount code in the description. It's a discount for 20%, and if these valuation spreadsheets interest you, you can pick them up right now. Now, looking at the 4th pillar in the red, the decreasing shares outstanding, they've actually been increasing their shares outstanding by about 91% every single year over the past 5 years, which is obviously expected as they are a new company and is a very standard procedure. Now, their profit margin is something very interesting, which is sitting at 72.5% and would be very high for any stock in any sector. Now, we can actually have a closer look at this. We can see that it has been rising since 2019 to 2023. In 2019, it was sitting at 54%, and currently it's sitting at 81.13%. Now, with such a high profit margin and their overall profits increasing at a very high rate, I believe that the company will manage to push their PE and price to free cash flow ratios in the ranges we'd like them to be in the next few years. But now let's have a look at the last 9th pillar, the long-term liabilities over the 5-year free cash flow negative dividends to be sitting below 5. And this is currently sitting at negative 0.11, and that is because the company had negative free cash flow over the past 5 years. But as we saw, the company generated 56 million in 2023 and even more in 24. So if we jump to the 9th pillar, we can see that they only have about $9.5 million in long-term liabilities, so that doesn't bother me at all. And now let's finally get to calculating the intrinsic value of HIMS, first using the Graham's formula revised. Now in this valuation model, we have to predict the 5-year earnings growth estimate based on the 9-pillar analysis and the research we do in the backend. Now as the company is fairly new, I predicted quite skewed earnings ranging from 30% to 18%, and then averaging it out with the analyst projections, we get a 5-year earnings growth estimate of 17.90% yearly. Now after taking all these 6 values, we get an intrinsic value of $13.80, which is 135% lower than the current trading price of the company. But we still have 2 more valuations to go through. So jumping to the discounted cash flow model, we plug in the free cash flow over the past 5 years. Now again, my predictions are quite skewed, predicting a future yearly growth rate of 20%. Now taking this growth rate, we calculate the future free cash flow. Now to move forward with the valuation and calculate the present value of that future free cash flow, we have to plug in a discount rate, which is essentially the minimal return you want from the company you invest into. Now again, we use the same method. I plugged in the highest year-over-year return of 9%, medium of 7%, and low of 4%, and this gives me a discount rate of 7.7% when averaged out with the WACC of the company, which is sitting at 10.40%. Now using the discount rate, we calculate the present value of the future free cash flow. We add all of that up, add cash and cash equivalents, and subtract total debt, which is very low. We then get an equity value and divide by the shares outstanding to get an intrinsic value of $19.87. Again, quite lower than the current trading price. And now moving to the final valuation model, the multiples valuation, where we compare HIMS to 3 of its competitors. We take these companies' current stock prices and divide by their earnings per share to get their PE ratios. Now looking at these 3 PE ratios, we already know that they are about 2/3 lower than the PE ratio of HIMS. So when we average them out, we get an average P of 27.75 and multiply with the earnings per share of HIMS, we get an intrinsic value that is about 2/3 lower than the current trading price, so $11.93. And now as HIMS doesn't pay out any dividends, we will skip the dividend discount model and get straight to the ultimate valuation, where we average out the 3 valuations and get an intrinsic value of $15.20, which is 53% lower than the current trading price of the company. Now, I'm not saying that HIMS doesn't have the potential to grow. It's quite the opposite actually. I do believe that they will grow a lot in the next few years. It's just that they are currently very overvalued, both compared to their earnings, their free cash flow, and compared to their peers. So I do believe that the company will fall in the next few months, and I wouldn't recommend buying it. But of course, if you want to do more research on this company and want to buy it anyways, maybe you can prove me wrong. Maybe the company will rise in the next few months, but personally, I won't add it to my own portfolio. And with that, if you did enjoy the video, make sure to leave a like and subscribe, as it really helps me out and allows me to create this content.